Hello, welcome back to this channel. Today's class, we are going to discuss about market shift and how we can use it in conjunction with trend POI and how it gives us a clear direction and clear way to enter the market. Market structure shift is the first sign that the momentum may be changing. It is a sign that price have shifted from moving in a certain way to moving to the opposite way. The first example we're going to use is this bearish market right here. Now, price is currently bearish, making a series of lower highs and lower highs and lower lows, where we expect each high to be used to create a lower low, like the scenario here. All right, but what did price do? Immediately price got to our support area, we saw that instead of making a lower low, it decided to take out the previous high to make an higher high. Now, this process, this point where it breaks out from the previous high, this is called the shift. And when this happens at a significant area like the support zone or the resistance zone, you can expect price to continue the trade in the opposite way. Once the shift happened, price used this newly created support as a support area to continue the uptrend. Now, same goes for this resistance. Price was currently bullish, creating a series of higher lows and higher highs, higher lows and higher highs. Then it got to a resistance area. All right. These resistance areas are areas where we expect sellers to step in. And sellers stepped into the market, and instead of price to use this low to create an higher high, it broke out of the low and used this newly created resistance. All right. The newly created high now acted as a resistance for price to start the downtrend. All right. This process of shift from bullish to bearish is what we refer to as the market structure shift. There are two ways I personally use the market structure shift. The first one is to confirm the start of the main move. Now, there is an approach I take to this. All right. Remember, the first approach is one, to mark out the trend. All right. The first approach is to confirm the trend. Is the trend bullish or bearish? That is the first approach in trading, all right? To confirm the trend. Is the trend bullish or bearish? In this scenario, we are using a bullish trend. So once you confirm the trend, it is step A. You mark out your support or resistance area. If it is bearish, you mark out your resistance area. If it is bullish, you mark out your support area. Since we are using the bullish for this example, we will be marking out only our support areas. Because in a bullish trend, we expect price to use the lows to create an higher high. We expect the lows to be respected and the highs to be taken out. Your step two is to wait for retracement into your zone, into your support or resistance zone. In this scenario, I'll be making reference to the support, but just know the opposite is for the resistance. All right. Now, price does not move in a straight line, obviously. It moves in waves. All right. And the retracement, which is the temporary pullback against the main move, will also move in wave. And the retracement is bearish, all right? So it will make a series of lower highs, lower lows, lower highs, lower lows. This is where patience comes in. You want to wait patiently until it gets to your support area. All right. Now, when it gets to your support area, the retracement is step B. Wait for this retracement into your support. Remember, in an uptrend, we expect the lows to be respected and the highs to be taken out. So this high right here is our target. All right. This is where we expect price to take out. Now, in a downtrend, we expect price to respect the highs to create a lower low, just like what is happening here. Price is respecting the highs, creating a lower low, respecting the highs, creating a lower low, and so on until it gets to our support. Then we wait for step 3, which is the step C. This is to wait for price to break out of an high. Now, the breakout of an high in this scenario will be this high, because this short-term trend here is a downtrend, and we expect price to use the high to create a lower low. All right. Now, the break of this high at this support confirms the shift of price from bearish to bullish. From bearish to bullish. Now, when this happens, when price breaks out from this high, this is called the step C. Now, when price, instead of creating a lower low, creates an higher high at our support zone, it is an indication that this bearish movement has come to an end and the main move is about to resume. Now, once you see that price has broken out of a previous high and created an higher high, this low right here becomes your new support. Because in an uptrend, we want each low to be respected and the highs to be broken. and price has created an higher high instead. So the next thing to look out for is for price to retrace into your new support and continue the main move to take out this high. That is the first way to use your market structure shift. The start of the main move. The first thing to identify is the trend. After you identify the trend, you mark out the support area. The second step is to wait for retracement into your support area, which is this small move right here, this temporary sale right here, into the support area. The third step is to wait for the shift, which is the break of an high to happen at this support area. The fourth step is to catch the buy right here, for price to use this newly created support to continue the trend. You already know the opposite is for the resistance. All right, once you confirm the trend, for this trend it becomes a bearish trend, so this area becomes your resistance area. You wait for price to retrace into your resistance area. Now in this scenario, the retracement is a short-term bullish move. The overall move is bearish, but the retracement is a short-term bullish move into your resistance area. Now your step C, which is your step 3, is to wait for price to take out this low. In an uptrend, we expect each low to create an higher high. But since this is the resistance area where we expect sellers to come in, and we see price violate this low, instead of creating an higher high, decide to create a lower low, we expect price to use this newly created high to create another lower low, because this is a sign that the market has shifted from bullish to bearish. Now, the second way people can use it for exit, because it marks the end of the main move and the start of a retracement. Let's say, for instance, we have an overall trend view, which is bullish. All right. And in a bullish trend, we expect price to respect the lows and take out an high. After price uses your support to create a new high, this point of break, this high where you expect price to take out and it takes it out, that point is called your break of structure. All right. In this scenario, the trend is still bullish. The overall trend is still bullish. All right. But after price breaks out of structure, a retracement is likely to happen. The retracement being a temporary move against the main move. Now, for this retracement to happen, you have to see another low to be broken. Remember, for this retracement to stop, price broke out from this high, confirming the shift from bearish to bullish. For this retracement now to start, this is the main move. This buy move becomes the main move. Now, for this retracement to start, price has to also take out this low, break out from this low. When price breaks out from this low, it is a confirmation that price has shifted from bullish to bearish. It creates a new downtrend down to our new support, then make the shift again. The cycle happens over and over again. This might be an entry signal. All right, this might be an entry signal. This is the start of the main move. It is telling you the market is about to be bullish, and since the overall view is bullish, you can enter at this reversal. But you see, this is an exit signal, meaning the sell is coming. If you are still holding your entries, you can exit here. This is an exit signal. All right, now there are just 2 steps to follow here. 2 steps. Step A is wait for break of structure, which is this BOS. Wait for price to take the high or the low. Wait for price to take the main high or the main low. Now, after the break of structure, step 2 is to wait for price to make an opposite shift. An opposing shift. The reason I'm using the word shift here is because I already explained it to you. This is the final idea. By final idea, I mean the conclusion of everything I've been trying to explain. The trend gives the direction, which is why you have to understand the trend first. All right. The trend gives the direction. Now, after you know your trend, You mark out your support or resistance areas, which you cannot do so unless you know your trend. This area is called your location, the location where you expect price to reverse. Now, market structure shift is the confirmation that indeed price has reversed. Market structure shift is the confirmation that you need. Market structure shift is how traders avoid bad entries and get exits. Using the line chart, we have explained what market structure shift is, but honestly, we all know it is quite easy to spot out things using line charts and drawing things. So spot out the market structure shift on the live chart. Price is currently in an uptrend, so what we do is we mark out our support. And this low right here created this high. This is an higher low, higher high. All right, this low created this high. This is actually a shift, all right, because price is currently rejecting off this support area. Price is currently rejecting off this support area, but I'm going to use this as a support area, all right, so you understand better. So if you take a look at this support area, price rejected from this area and broke this high right here. Now, after the break of the high, we experienced a reversal, a pullback to tap at the support right here to continue the trend. If you switch to line chart, it becomes more obvious. And also, price delivered to the break of structure. All right, this is called the break of structure, here we refer to as BOS. This is the main move. All right, as you can see, after the main move, this price shifted. All right, price shifted, broke out from this low right here. And after the shift, what did he do? Continue the retracement. This is the shift for the main move. All right, and this is the type 2 way to use it. All right, the shift to confirm the retracement. And what happened again? We saw this shift, price broke out from this high, all right, and we traced back to use our newly created support to continue the trend. If you switch to the line chart, it becomes very easy to spot. You see how price took out the high, came back to use our support to continue the trend. You can see price is currently making a series of higher lows and higher high, all right, so this is our target high. Here we expect price to take out, and price indeed took it out. But first, we are going to concentrate on the smaller moves, all right? We already know this is our support. This is the support area where we expect buyers to come in. And when price got to that support area, this is where we experience the shift, all right? This is where we experience the shift from bearish to bullish. And what the price did after the shift came back to test our newly created support to continue the shift. And this becomes our first break of structure. This is our first break of structure. After this break of structure, what do? It reversed again. All right, it reversed again to start the new retracement to use our support to continue the trend.